you'll be super excited to hear this because in this webinar 5, I will be detailing the exact breakdown of what exactly the world's easiest portfolio is and what exactly you need to buy and what exactly makes up this portfolio that you will be creating. So what exactly will we cover today? The exact world's easiest portfolio strategy. Woo! And the breakdown of each component, and I'll explain why we buy each component of this world's easiest portfolio. And thirdly, why buy so many different kinds of ETFs? You understand this when you go more in depth into the strategy as I go through the slides. And finally, the golden rule of the world's easiest portfolio and how to utilize it. So this is basically the world's easiest portfolio, and the answer to what I've been alluding to in the past webinars and Facebook posts and Facebook ads and website. So it comprises of, firstly, a world ETF, secondly, an US-based ETF, thirdly, a Singapore ETF, which we have covered in one of the previous webinars, and fourth, a bond fund. So these are the four things you need in the world's easiest portfolio. So let's dive right into each individual component and why we must buy each individual component of this world's easiest portfolio. The first is a world ETF. So for the world ETF, you'll buy an ETF that tracks or copies a world index, which is based on the performance or follows the performance of major developed countries in the world, such as Europe, sorry for the spelling, US and UK, as well as a few emerging economies such as China and India. As the global economy grows, which has been the case since the dawn of time, your money grows too, and your ETF value increases in value. The second ETF that you will buy is a US-based ETF or an ETF that tracks or copies a US index, which is based on the performance, of course, of the US economy or the basket of companies in the ETF from the US. So why the US in particular? Well, you just need to look at one index from the US, which is the S&P 500, and this is the index performance since 1950 all the way to up to this year of 2017. And you can see that despite various dips and falls in, for instance, the 2008 and 2002 or 2003, because of various financial crises, the index has risen tremendously. And as mentioned in the previous example of how $1,000 can grow to almost $5 million in 90 years if you are invested in the S&P 500, this is the graph that illustrates the exponential growth that this index has and the power and resilience of the US economy to grow throughout time, no matter the obstacles it has faced in different years. The third thing that you will buy is the Singapore-based ETF. So for Singapore ETF, you will buy the only ETF that exists now that tracks the STI, which is the STI ETF, which I mentioned before in the previous webinar. So why buy Singapore? Why not pour everything into the US ETF? Because it has a better return. And the US ETF does have a better return. Well, this is because you want to have an ETF that has higher liquidity. So if the if the Singapore to US currency exchange rate is fluctuating a lot, it's very volatile, is disadvantageous to us when we sell it, then some returns might be lacking. Some returns might be negated in a way because of currency fluctuations. We want to buy an ETF that is based in our own country, and when we sell it, we can get local currency. And therefore, in this case, we will not be affected by currency fluctuations. And in any case, the Singapore ETF does follow closely and performs in tandem with the US ETF's performance because Singapore's economy is very tied and linked with the US economy. So the Singapore ETF is the third thing that we must buy. So now you ask me this question: why do we need to buy so many different kinds of ETF? Why don't we just pour everything into maybe the US ETF or the Singapore ETF or the world ETF and just concentrate all our money in there? Well, that's because the nature of economies are cyclical. So cyclical means that there's a natural cycle of things. Economies will perform well at certain points in time and will perform badly at certain points in time. There is never an economy that performs good throughout all the way. So there'll be highs and there'll be lows. And therefore, we must own multiple economies or multiple ETFs that reflect these different economies. So that, for example, the US is up, Singapore is up and the world is down, we might still be making money. And if the US and Singapore is down, but the world is up, we won't lose as much money as if we just invested in one ETF alone. So because economies go up and down and we cannot predict where they will go in the future, we protect ourselves through diversification and by owning multiple economies and multiple ETFs, as mentioned above. So just to re-emphasize the idea that you buy so many different kinds of ETFs, world, US, and Singapore, is because you want to have diversification. So for instance, in the year that you may want to sell your ETFs to realize your profits, like when you're near retirement or when you're much older, it might be a bad year for the US. But because you have, say, a world and Singapore ETF, your portfolio might still have a very profitable, might still have a large amount of profit to be realized when you sell off the ETFs. So you diversify by buying ETFs that track major stocks in that country, and you diversify again by buying ETFs of different countries. As the world grows, so do you. And we aren't done yet because we have only talked about ETFs in our portfolio. Remember bonds that I mentioned in webinar 2 when I talked about stocks and bonds? So 100% stock portfolio is exceedingly risky as stocks are really, really high risk, as mentioned before, because you never know where they're going to go. There's a lot of volatility and it's based on a lot of market sentiment and irrationality. So when stocks perform badly, bonds might be doing fine. And this is another level of diversification that we must have, that we must own stock funds, such as ETFs, and we must own bond funds, which will protect our wealth when ETFs go down. So a bond fund is the fourth thing that we must own in addition to the 3 ETFs. So the rule of the world's easiest portfolio is that your bond fund percentage of your total investment amount should be equal to your age. So what does this mean exactly? It means that if you are 30 years old and you're investing $1,000 as investment capital, then $300 will go to bonds and $700 will go to ETFs. So this is just a rough rule, but it's a very good gauge that if you as you get older, the percentage of bonds in your investment portfolio will grow, and this will protect you from volatility. And as you grow older, you want to have less risk as you because your earning power decreases or you lose your job or that kind of thing. So because of that, your bond percentage must go up as your age goes up, and your ETFs will decrease in proportion as you get older. So this is the rule of the world's easiest portfolio. Your bond fund percentage is equal to your age, and the other 3 ETFs, world, US, and Singapore, are divided equally with the remaining money. So here's a summary of today's webinar. So the world's easiest portfolio is really easy. We have a world ETF, a US ETF, a Singapore ETF, and a bond fund. So it's very easy it's so simple and it's so easy to maintain. You don't need to trade frequently, but simply inject new funds every year to grow your portfolio in the ratio that you have determined in the previous slide. Through compounded returns and the pure growth of the world, US, and Singapore economies, you will see your money grow exponentially. And that is the world's easiest portfolio. And I hope you guys will grasp this concept well. And if you don't understand anything, don't hesitate to ask me any questions regarding this, because webinar 5, this webinar, is probably the most important webinar where I lay out the exact things that you need to buy that makes up this portfolio. So after this webinar, please don't hesitate to ask me any questions. And next week on Tuesday, there will be the last and final webinar, webinar 6, where I will be covering some words of caution and advice on when you embark on this strategy and the obstacles you face, and how you can gain some clarity when you go down this path of embarking on your world's easiest portfolio journey. So I have a few more surprises in store for you after next week's final webinar, and I hope you all stay tuned to next week's webinar and the surprises that come afterwards. So thank you so much, and any questions, please don't hesitate to ask me or private message me. Thank you so much.